Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 335th VideoCast podcast for the week ending March 19th, 2026. We've got a lot of stuff to cover today, as you can probably imagine with what's going on in the markets. But as always, family first. Let's get down to it. There's Mimi at Erewhon. I guess Caitlin took her there. She wanted to go there in Los Angeles. She's on her way up to the USA Water Polo Olympic Development National Championship Tournament. I think that's round 3 for what they do, and super excited for her. And then we've got Annabelle here, competed in the Spring Age Group Championships. Her relay team broke a 16-year-old team record in the 400 medley with a time of 4:05:13. Annabelle also broke a minute in the 100 back to go 59.60 to rank number 1 in the nation for her age in that event. So congratulations on that for Annabelle. That's her team who broke that 16-year-old team record for Nova Aquatics. And that's me with Annabelle. She had a little basketball tournament at her school. That was in Palm Springs. Went out with a few friends, watched the big tennis tournament there. I can't believe the size of the stadium they had there and the beautiful setup and everything else. That was a friend came out from Connecticut, had him up to the club to play with. That's Robert and Desiree. And then I want to thank Drew for hosting a few of us out in the desert. Got to play the Hideaway with Daryl and Tom. We had just such a wonderful couple days out there in Palm Springs. That was my first time out in the desert. Really, really special time with the whole group. So let's get down to business. Had the pleasure to join the great Stu Varney today on Fox Business. Thanks to Stu and Maggie Edwards for having me on. We're going to tune in here.
We got the Dow down 200 this morning, and we got the Nasdaq down 137. Interest rates up, oil up, gas up, market down. Tom Hayes joining me this morning. All right, Jay Powell says stagflation is a 1970s term and not what the U.S. is facing today. What do you say to that there, Tom? Because we do have inflation picking up and the economy is slowing down. Are we close to stagflation?
Well, Stu, the only thing that's stagnating is the price of the S&P 500 for the last 6 months, and it's driving people crazy. This is nothing like the 1970s. You had double-digit inflation. You had double-digit unemployment. Our unemployment is at 4.4%. Our CPI inflation is at 2.4%. I think you do not want to be short this market here, Stu. People are very nervous. If oil stays elevated, obviously we have a problem. But if you look at earnings, estimated to grow 15.3% this year. GDP now is at 2.7% for Q1. So long as this gets resolved, and when I say resolved, I don't know if when or if the war gets resolved. I know resolution looks like ships getting through the Strait of Hormuz. I think there's a lot of gas in this tank for the economy, and I think it's nothing like the 1970s. We're a net exporter of oil.
Okay, Tom, we hear you. Thanks very much for joining us this morning on what is a difficult day. We'll see you again soon. Thanks.
And we're back. And then want to start to get to some high-level charts here. We got a tremendous amount of data to cover, and obviously a tremendous amount of Ask Me Anything questions. So here is from Slumer over at RBC. We're looking at the 30-year yield and the 10-year yield knocking on these very, very important levels. Would be very, very nice if it holds this downtrend. We're going to talk about why we think that is going to be the case and why we're generally more sanguine than most at these levels. But we're going to back it up with data, and then we're going to let things work out as they are. You can see energy had that huge spike. Retest here, now kind of testing up against these levels to see what they do. They're thinking about removing sanctions for 140 million barrels on the water that the Iranians have on the water. That'll be about 10 to 14 days worth of supply, unilaterally releasing more barrels in the Strategic Petroleum Reserve in the U.S. just to hold things down in the short term until they can get the job done over there and take control of the strait. Once they take control of the strait, it's over. The war could go on for who knows, but like the stock market event is over. And then here is a long-term S&P chart. And this is what I referenced talking with Stu, is that basically you've had this choppiness since basically October 1st. The market is back to where it was October 1st. So for 6 months, one of the narrowest ranges, chopping back and forth. And in the meantime, the fundamentals continue to improve. For now, I think that's going to continue to be the case if they can get through this in the next couple of weeks, or at least start getting ships through. I think we're going to be just fine. So whether you look at the S&P, the NASDAQ, the Russell, the Dow, it's all the same story. If you went on vacation October 1st and you came back, you're effectively at the same levels after all that noise. Maybe you should have gone on vacation for the last 6 months and come back. Here's the NASDAQ, exact same story, going all the way back to October 1st. And then here's gold starting to roll over. We can talk about that a little bit later. Want to zoom out, which is a key theme of the Hedge Fund Tips with Tom Hayes podcast, which is critically important. This is something that we've covered many times. It's kind of a 17-year cycle that has repeated itself over and over. And what Robert's not emphasizing here is that it's predicated on demographic spend. So the highest spend of the largest percentage of the population tends to be between age 30 and the early 40s or mid 40s, I guess nowadays, when it starts to slow. And right now that correlates with between now and 2034. So we're kind of halfway through the cycle. We had that sideways cycle from 99 to 2016. We broke out. So from 2017 to now, about 9 years, we've been going straight up, which implies another 8 years of expansion to S&P 14,000. And you can see that. Now, that doesn't preclude, you can see in the last 17-year upcycle from 80 to 83 to 2000, you had 20% corrections along the way, 10% corrections along the way. That's just par for the course. Same thing between 1948 and 1963, exact same story. But the trend is up. So whether you get a pullback here, if you take a longer term view, any weakness is an opportunity to buy things, and we are doing that in spades. So that's that. In periods like this, I do like to zoom out to put things in perspective, because the day-to-day moves can drive people crazy and think that something's happening to the underlying businesses. And if this persists in the markets, we'll go through company by company and look at free cash flow. And you can see how in most cases, not only is it not getting worse, in most cases, it's getting better. Revenues are getting better. Margins are, because we're in turnarounds. Turnaround Tom. And that is, that's the key thing to keep in mind when the daily headlines are nuts. How is it impacting the underlying business operations? Now, with software, which we haven't had exposure to, which a lot of those companies are down 50%. If you were overweight software and tech, you could have a portfolio down 30 to 50%, even though the indices are down 5 or 6. Because you have fear of disintermediation through AI. It's overblown on the one hand. On the other hand, some of the multiples at which these companies were trading at, they may never trade at again. The business will do better than is feared, but the multiple will contract because they were trading at 40 times multiples because the market thought they would grow at 40% forever. And now with AI disintermediation, those growth rates may drop down to 15 or 20%, in which case the multiple may re-rate from 40 to 20, and you get 50% down, and it stays down even though the business continues to grow. And that's something you need to keep in mind. And we've avoided that, the businesses that get disintermediated by AI. And so we can just ride out the short-term volatility. So we're going to cover a bunch of stocks that we've talked about on the podcast over the past 6 or 12 months and more. Dentsply Sirona, this is short-term noise about, supplies, anything related to input costs, et cetera, because of oil prices. These things are overshooting. If you look at the underlying business and the turnaround and the free cash flow that we covered last week with their ability to generate, which was our core thesis, they could generate another 120 million of free cash flow, which they have. Leader in dental supplies and dental technology. Nothing to worry about here. Short-term noise. That was biotech, which we took profits on, by the way, back here. That'll work higher over time, but it's not a core focus of ours. Here's VF Corp, again, consumer discretionary. This is something that I wanted to cover. I'll cover more of this in just a minute about why we think there's a huge opportunity in consumer discretionary. Who would be talking about consumer discretionary when gas prices are up $1 at the pump and the war is never going to end and consumer confidence is at all-time lows? That's the exact time that you want to be buying consumer discretionary because everyone's underweight and they will chase into it. And you see these type of moves on every single recovery. You have that first move, fake out, second move, fake out, and then straight up. First move, fake out, second move, fake out, then straight up. First move, fake out, second move, fake out, and then straight up. And Bracken is hitting on all cylinders. We'll cover that in just a second. Bonds, short term, yields going out because oil prices going up, because fear of persistent inflation means the Fed can't cut. Expectations of Fed cuts have gone from 3 down to 0 in 5 minutes. Overreaction. But that's the opportunity in the markets. That's why I love public markets over private markets, because they serve up these excessive dislocations. And most people cannot sit on their hands when this stuff is going on and do nothing. They have to busy themselves with activity. They have to desperately start selling stuff or buying stuff or whatever. And if you got to do one of those two things, now's the time to be buying stuff and finding things that you can take a 3 to 5 year view and just ignore the short-term dislocation. Look under the hood at the cash flow, the revenues, etc. Stanley Black & Decker, same story against material input costs. This is exactly normal. We saw it in 1999 to 2001, right before it took off for many, many years back to new highs by 2027. Same type of thing in 2010 and 2011. Started to get going, got hit in the head, and then straight up for many years. And this recovery will be no different. This business has been around since 1899. Talk about a picks and shovels play on construction, data centers, housing will recover at some point. I know no one thinks that's ever going to happen, but it absolutely will. And this will be a huge leveraged, incredible play now that they've taken all the costs out of the business and right-sized everything. The operating leverage is going to be massive. But in the meantime, it went from 80 to 70 and everyone was like, what's wrong? What is the market trying to tell me? The market's trying to tell you had a bunch of schmucks on too much margin that are getting margin calls and being forced out of great companies. That's what the market's telling you. So you can listen to the message and say, oh, I'm going to benefit, out of every, out of every crisis is opportunity. And most people see crisis for what it is and they sell everything in an emotional response. And the few and the type of people that are on the audience of Hedge Fund Tips with Tom Hayes takes advantage of that chaos and opportunity. So they buy it at 70, and if it goes to 60 before it goes to 150, they don't care. They'll buy a few more shares, or they'll sit on their hands, or if they bought it at 80, they'll just sit there and wait. And 3 years later, you're at 150 and you're rocking out because you got paid for doing what other people wouldn't, which is sit still. QXO, Brad Jacobs building supply roll up. All you have to do is sit back and let that guy make money for you. He did it in United Rentals. He did it in XBO. He did it in GXO. So that's exciting. Papa John's, we got that silly offer last week for $47. That's a non-starter. Let this thing work its way back up to 80 to 100 over the next few years, and we love it here. So does it go to 28 before it goes to 88? I don't know. I don't care. If I have cash around, I'll be buying it at 28. or the Qataris will come in and make a reasonable offer of $70, and hopefully someone else will come bid it up 75, 80, and we'll get taken out too early at too low of a price, but the IRR will be acceptable. PayPal, we've covered this story. This is in recovery mode. Enrique Lores is doing exactly what he did at HPQ, buying stocks, cut costs, focus on brand and what matters, and we'll hear more from him in coming weeks. But he's not a newbie. He knows where the coffee machine is. He's been on the board for a couple years, and he's run this playbook many times in his career. Very excited about that one. Pfizer just starting its recovery. So it's like when you zoom out on these, what I'm trying to do here, ladies and gentlemen, is just show you, like, you know, if you look at the mark to market on a day-to-day, you pull your hair out and you'll make stupid emotional decisions that cost you fortunes. If you would just stay still, at the very least, just stay still. At the very most, put in more money to buy things when they're on sale. That's like the super winners. Those are the people that get exceptionally rich. But the ones who get rich are the ones that can just sit still during periods like this. And the ones who stay poor and mediocre are the ones that have to take action because they can't help themselves, because they're very emotional. And there's nothing you could do. It's just human nature. It's genetic. Good investing is genetic. National Oil, Varco, okay, it's been straight up for since mid 2025, almost a double off the lows. It's checking back a little bit. We're going to talk about that one today. This has a long runway. We believe we're in a multi-year cycle similar to the early 2000s, where international outperformed US equities, small outperformed large, and value outperformed growth. And there's a lot of noise now going around from all the people that were pushing these stocks at 100 times sales and selling SPACs that people lost a lot of money. They're now saying that be in these hard asset cyclical plays, like basically what our portfolio is. So now they're all getting on board after they lost 50% or more in their software stocks. Now they're all saying, what we do looks like a good idea. So, you can't make this stuff up, but you've been around long enough, you see it all. Intel, straight up, taking a rest. We took profits off on half the position. We're going to ride the rest with Lip Bhutan. He's a proven winner on the house's money. Hormel, doing nothing. We're collecting a 6% dividend while we wait. This will work itself higher over time. They've taken out the cost. They've right-sized the business. GXO Logistics, short-term monkey hammer. This is what it does. They're executing on all cylinders. Blue skies in the U.S. The logistic excess of supply has been largely soaked up. This thing is an operating leverage machine over the next 3 to 5 years. And Kelleher, if you didn't listen to the podcast we did with him, we did a whole hour with the CEO of GXO a couple months back. You definitely want to check that out. Canada Goose, record revenues, record cash flow, can't give away the stock. This is in the consumer discretionary bucket, which we're going to talk about in a minute. That's going to do well. Once you come out of this, you're going to see consumer confidence fly. You're going to see everything. So the key is, how long does it take to get out of this? Because if it takes too long to get out of this Iran situation, then you're going to just undo all the good that has been happening for the last 18 months. But if you can get out of this in a matter of weeks, meaning ships get through the strait, then boy, oh boy, are we going to rock it. Because not only do the fundamentals support it, but the positioning, which we're going to cover, is just like a wet dream if you want to be long, because so many people are selling in the hole and hedging at record levels, like COVID low levels, that we're set up for a rip your face off rally, is what I'm getting at. And we're going to talk more about why. Etsy, it's like nothing happened. I mean, these guys are like, no, we got record revenues, record free cash flow. Stock hasn't even moved throughout all this. Estee Lauder, huge move off the bottom, tripled off the lows. But like every recovery, you check back, you consolidate before your next multi-year leg high. This time is no different, but in the short term, people get crazy. Disney, brand new CEO, we'll cover that. Basically, the experiences business is worth $80 a share. You get sports, movies, entertainment for free. And by the way, all those businesses are growing and cash flow positive. Diageo, look, if the war continues, people are going to start drinking a lot more, so you'll make your money either way. But this is not a lot different than the early 2000s, when it was down for 3 straight years and then the great financial crisis, and then sooner or later it recovers because they're best in class. And even if people drink a little bit less in the developed world, they drink higher quality stuff. In the emerging world, as the minute they get money, they like to start drinking. So Diageo is going to help them out, and that's just the way it goes. So Comstock research, I'm not saying it's right or wrong. I'm just saying it's the way it is. So that's we want to participate, especially at these prices. Price is what you pay, value is what you get. Comstock, everyone, when the tobacco businesses went out of favor, people could say alcohol is the new tobacco. I wouldn't totally disagree with them, but when you have those type of businesses that are huge cash generators, like Diageo, 2.8 billion of free cash flow. So like how many years have cigarettes been out of favor? 25 years. Well, British American tobacco has gone from $2 to $63. It's paid out almost 10% per year in dividend yield. So the strong get stronger even as the industry consolidates. And again, they had the emerging markets, they had Asia. The good liquor companies will be no different. It's just a short term. There was massive oversupply, massive excess in that industry during COVID. It's worked its way through, and now we'll start to recover. So I'm not worried about that one. I'll leave the worry to the rest of you. You can send me your shares, and we will be happy to pick them up and build a position in one of the global hegemons of the high spirit business. Comstock Resources partners with Jerry Jones. He's got 71% of the equity. $8-9 basis is at 21. It's going a lot higher. This thing will be over 50 over the next few years and probably even higher. Cooper Standard, in the short term, it's like, oh my God, what happened to the stock? In the long term, look, we were putting this position on May 2022. Go back to the tapes, $5 and change, went straight up. It got excessive in after the last earnings. They refinanced the debt. They've got no maturities till way past 2030 now. All it's about is volumes. They've taken all the costs out of the business. Even if volumes are flat, they're making money now. It's just so unbelievable, the execution. So it pulls back in the meantime. It pulls back a lot more. I'm going to be able to put new clients in it, which is pretty exciting. Crown Castle, this is just an interest rate play. It's off the lows, 76 up to 84. This will push higher over time. It's a duopoly with American Tower. Baidu, same story. It's just resting. Baxter, you can't, healthcare got hit this week. Just go into any doctor's office, any hospital, any emergency room. All of their brands are there. There's a fear on health spend because of the government allocations, et cetera. At the end of the day, people are going to get sick. People are going to break things. They're going to go to hospitals. Baxter's going to be fine. Hitter is going to apply the Danaher way to Baxter. And in 3 to 5 years, people are going to say, oh my God, I can't believe I didn't buy this below 20. It's now a $60 stock and we're an $80 stock. Alibaba, okay, so we'll talk about their earnings today, but we'll do a comprehensive thing in a week or two. By the way, this is the 10th consecutive quarter they had triple-digit growth in the AI. That wasn't part of the headline. We'll cover their headlines. But, this is normal, okay? You have these huge recoveries. You consolidate for a little while and until you get the next leg higher. This time is no different. We may have to consolidate for a little while before we get the next leg higher, which is why we took off the call spreads last year at a 7x profit. We kept all the stocks, so we'll ride this short-term volatility. We expected that. When you get a parabolic move, you have to consolidate and rest before you make the next leg higher. But again, still the cheapest AI play in the world in an area that we want to have exposure with, which is international. Boeing, this thing, you're waiting for the 500 plane order when Xi meets with Trump, which is now delayed. So this is going to just rest for a little bit. They'll make some announcements. It'll probably shoot over $300 sometime this year. And then we'll start to look at, how much longer we want to own it, because no one wanted it in the 130s. A lot of people wanted it at the 250s. A ton of people are going to want it above 300, and we might have to help them out. Advanced Auto Parts just starting their recovery here, like you saw in the great financial crisis. You have that huge fake out. Everything looks good. You retest, scare out the late sisters who bought up here. They got scared out. Now it's just working higher, and for a multi-year recovery, very cyclical business, huge operating leverage. That's kind of our playbook, ladies and gentlemen. If you've been paying attention for a while, we do these things over and over and over, and we ignore days like this and the short-term noise, and whether it's a Iran war or it's SPAC blow up in 2022 or VC blow up. I mean, it's all the same. It's headlines to take you out of your stock. If you've done the right analysis and you have the proper framework and you understand what you own, you're not just buying stocks because they're down in price. You're buying stocks that are down in price relative to underlying, consistent, predictable, durable fundamentals. We don't buy hope and wish stocks. We buy stocks that generate cash through cycles for decades upon decades. So when the price gets dislocated from the underlying fundamentals, we pounce and we make our doubles and triples over a few years, and then we rinse and repeat. And that's what we do. Everyone else likes to chase the shiny objects, and you can make a lot of money in a short period of time until you don't. And they all blow up, and then you just don't hear about them. 3 years later, they made all this money on the way up. What happened to them? They're toast. So that's the story. This was some of the stuff we wanted to cover on Varney this morning, but they were tight on time. The Iran volatility, we think this is similar to tariff volatility last year. It started with a tweet or a truth. It will resolve with a tweet and truth. I think at the end of the day, it's a worthy sacrifice. If we can keep Iran from getting nuclear weapons, the world is better off. So if we got to take a little short-term volatility and buy a little more stock that's on sale, worse things have happened. I will say that what I'm seeing in the market is everyone is now buying insurance in the hole after the house is already on fire. Historically, they will not get a payout. Okay, we're seeing record hedging, record put buying, record shorts. Opinion follows trend. Everyone's short in the hole, which implies what happens when you write all this premium. The dealers selling this premium are not idiots. Okay, what happens in these environments is either the market churns sideways for a while until resolution, which means the puts that you bought at the money or out of the money expire worthless, or you get a rip your face off rally coming to a theater near you. And with this level of short interest, so you can see this short volume, if you're listening, I'm sorry, you're getting great value, but you get 10 times the value when you watch it and you can see these charts and visualize them. We haven't seen anything like this short volume. Not in 2022, not since COVID. Also, retail crowd is all in long oil. They're going to get their faces ripped off. There's going to be they're going to wake up one morning and 10, Western ships got through the Strait of Hormuz, either with or without escorts, and oil's going to drop to 75, and these guys are going to be roasted. It's too late. You missed it. Okay. So, 1 month put skew index. So you're seeing put skew at levels that you have not seen since the COVID low crash. The demand for insurance after the house is on fire hasn't been this aggressive since the COVID lows. And that was when you wanted to be a buyer, not a seller. Does that mean we can't go lower for the next month? No. Does it mean the odds are in your favor to be getting long exposure versus short exposure? Hell yeah. So that's what I would say about that. And then asset managers' net position has not been this low to equities since the COVID lows. People are scared to death. All the narratives. I mean, look, if I'm running a TV station, I'm going to be running World War III headlines all day long. Why? Because people tune in. It's like every snowstorm. They say it's going to be an avalanche. It's going to be a blizzard. Turns out you get a dusting. Why? Because when it's going to be an avalanche and a blizzard, you run out to the store, you buy cans of food, you do all the crazy things people do, and you watch the TV. And if you watch the TV, they get paid more money for the ads. So it's no different than this situation. It's not to undermine that this can't turn into something serious, because it is serious. I talked to a friend in Dubai yesterday, and he's like, everything's great. The government's good. We get a notification on our cell phone every few hours that a bomb's coming in, that they're going to intercept it, and life goes on as normal. The head sheikh was at the Mall of Dubai walking around with their top leadership, showing leadership, not talking leadership, and all is well in Dubai. But yeah, every 3 hours they get a text message. So it is what it is. But everyone's doing what they're going to do. They feel good about it, and it'll be over soon. Biggest underweight to consumer discretionary since December 2022 market lows. I've told you guys that there have been 2 times in my career when I've gotten clients on and done a special video and said, number one, I've never pitched anyone on investing with Great Hill Capital. Everyone's come through existing clients or through the podcast. They listen, they get value, they see that the framework works, and then they call me and invest. There have been 2 times when I've aggressively talked to people about sending in money. One was the lows in 2022, and one was the lows in April of last year. I did a video for clients. I said, if you're ever thinking about putting in money, you put it in now. The ones who did last year made a fortune on that, and same with October 2022. And we have not seen consumer discretionary this low since December of 2022 market lows. Okay. And that's why I'm talking about consumer discretionary, because everyone is short and underexposed this sector to an extreme. So the 2 consumer plays I was going to talk about, obviously VF Corp at these levels is a steal. You had a 26 bagger with Bracken Darrell. He did Logitech. He's taken $300 million of cost, sold off Supreme, sold off Dickies, paid down the debt on the balance sheet. 75% of the portfolio is now growing versus 10% 18 months ago. He's doing everything the say do. He's doing everything he said he was going to do. Vans is taking a little longer than he thought it would, but everything else is going better. Vans is starting to turn the corner. Americas is turning the corner, strongest growth in 3+ years, and we think this stock can triple over the next 3 to 5 years from these levels. Disney, brand new CEO, Josh D'Amaro, 54. He served as chairman of Disney Experiences since 2020. $36 billion division. Last year, record revenue, record free cash flow. Shares have been flat, down 50% from 2021 highs on $94 billion of revenue, and operating cash flow of $18 billion, free cash flow of $10 billion. Some of the parts, experiences alone at $10 billion of EBIT is worth $80 a share. You get streaming, film, sports, ESPN, et cetera, for free. They did $7 billion of buybacks last year, $2.5 billion of debt. So returned $10 billion to shareholders, 5% yield on combined yield on that alone. So we like those stories on consumer discretionary. Okay. Morgan Stanley's released a landmark research report projecting that China's AI cloud market will surge at a compound annual growth rate of 72%, surpassing 218 billion yuan by 2029. Alibaba, recognized for its comprehensive full-stack strategic layout, has been designated a top pick with its cloud revenue forecast at 45%, the highest projection across the entire market. By the way, as quote-unquote crappy that today's earnings report was, which it wasn't, by the way, they have to invest to stay ahead of everyone. Their cloud business grew 36%, and it was the 10th consecutive quarter that their AI revenues grew triple digits. Okay. So that's that. More critically, the report highlights that an unprecedented cloud service price adjustment cycle unseen in 2 decades is on the horizon. The inflection point in profit margins may well represent the market's most significantly underestimated variable. Amen. Hallelujah. Hedge funds dove into oil bets. Again, chasing opinion follows trend. Everyone getting long oil at the exact wrong time, just like everyone was getting long gold at the exact top, and that's now rolling over. Dow Jones. These are some important charts to follow from Trend Labs. JC Parrott's over there. You can see here, this is pretty normal behavior. The Dow Jones Transportation Index broke out after 6 years from a consolidation range. So breakout, back test is normal. You tend to get some recovery after that to new highs. Emerging markets, again, broke out to new highs after, again, 6 years, breakout, back test, and then you work to new highs. Small caps, same exact story, 6-year sideways, broke out, back test to shake out because everyone buys the breakout. You screw the traders, and then you take off for the long-term investors. Short ETF volume, again, record. VIX positioning, you can just see everyone's on one side of the boat, going to get smashed. Here's a list from Charlie Bolello at Creative Planning of all the corrections, 5% corrections we've had since the March 2009 low. And you can see This one's been 44 days with a 5.5% decline. We've had quite a few of these. Average decline 7.6, 26 of them. Average last is 26 days. So we're due here. Overbought. This is from Bespoke. Bounce is likely. I think we're going to wake up to a rip your face off rally here in coming days or weeks. We're going to get some type of resolution that the market likes, and then the market will ignore the rest. Here's the Cloud Intelligence Group. Here's the 10th consecutive quarter of triple digit. Revenue from external customers grew 35%, up from 29% last quarter. No one's paying attention to it. That was the opportunity. By the way, some new money came in today. Alibaba was one of the positions, just saying. One of the places we put it to work. McClellan. When the McClellan oscillator is below negative 94 with the S&P around 5% of an all-time high, what happens? A week later, up 1.5%. 3 weeks later, up about the same. 1 month later, up 3.2%. 2 months later, up 4.1%. I could easily see a scenario. I think this thing wants to push above 7,100 before we get the fall weakness into the election. So if you're shorting at these levels or selling at these levels, I'm really sorry for you. You may look right and feel right in the short term if we go down another 3 to 5%. But when it turns, you're not going to. It's going to turn so quickly. It's not going to let anyone in. That's the way these things work. Here's PayPal. This is from Charlie Balela, looking at price to sales, record lows, 1.3 times. PE 8.6 times. Free cash flow $6 billion. When you can buy that kind of business, that's still growing, by the way. The assumption is that it's not at these multiples, and you don't. I mean, I don't know what to tell you. So next, stocks have bottomed. Okay, this was from Ryan Dietrich. He was talking on average. Mid-March, stocks tend to bottom for the last 20 years, and by December, they're up 10.4% on average from those lows. That actually makes a lot of sense, because I think for the year, the likelihood is the indices are going to be up only 5%, 5 to 8%. So if we're down 5 and we get a rally, so 10%, that would make a lot of sense. What else do we got here? Housing affordability turning up. Number of new leases for U.S. warehouses over 500,000 square feet by quarter. This is very, very positive. So the trough, as we had said many times, was Q4 2024. Turn the corner and the demand is picking back up. That helps GXO Logistics. Policy shock. What do we have here? ETF flows. You haven't seen this type of selling in ETFs since April 7th. Which is why I continue to say this reminds me a lot of the tariff scare last year, which, by the way, bottomed on April 7th. So we haven't seen this kind of forced selling since those levels. Now that everyone's getting flushed out, I wouldn't be surprised if we see some very good things next week. Generally, you don't get it right before the weekend, but maybe we'll get some positive developments. Here's the put skew that I was referencing. You haven't seen this demand for puts or insurance after the house is burning since the trade war last year, and then prior to that, the COVID crash. So these are times you want to be buyers, not sellers. U.S. economic cycle turning up. That's industrial production, which we've talked about for many weeks. Housing cycle showing signs of improving. I know you wouldn't know that from all the headlines this last week. Big banks breaking down. I don't know how you say breaking down when it's a breakout, back test, normal. Very similar. Breakout, back test, move higher. Excess liquidity is rising and supportive of stocks, by the way. It's still the case that the Fed is doing quantitative easing, not quantitative tightening. And we talked about it in past podcasts, but the exact amount is approximately, let's just pull this up. Back in December, Fed quietly restarted balance sheet expansion, buying treasuries at a pace Powell said himself would require $250 to $300 billion a year permanently. Fast forward to today, Fed's now pumped $100 billion into the economy over the past 3 months. In the summary of economic projections, the Fed raised its growth and inflation projection. What did Powell say about the ongoing aggressive balance sheet easing that happens to promote growth and inflation? He did not mention it, and no one asked about it yesterday, which is interesting how these headlines are diverting from other things that are happening. So with that amount of liquidity, with the tax returns, you get one positive headline, aka a few ships or something else, or Trump declares victory, or an Iranian leader raises the white flag, or whatever it happens to be. And God help you if you're short or in cash and you wake up to limit up open, you won't know what hit you. So US GDP growth rate, that was Q4. The GDP now is at 2.7% for Q1. Private equity is tumbling with the S&P at all-time highs. The private credit concerns are going to start to ease. I know that's hard to believe right now. I do think it's going to be a major problem. I think it's going to be pushed down the road. Once the Iran thing is in the rearview mirror, you'll get a rally in stocks. You'll get expectations for cuts go back from 0 to 1 or 2 with Warsh coming in. They'll get Powell out. They'll discontinue his investigation and kick him out, and that'll be the trade. Warsh will go in, probably start with 25 or 50 bips, and the game will be on for housing, etc. Banks selling down. We can start to look at opportunities in financials. We have our play in financials with PayPal. The margin of safety is so much greater than most of the banks, so we're not like anxiously urgent to do it, but we're paying attention. Here's that chart on the Russell 2000. After all these years, breakout back test. This is kind of normal behavior that you see for the technicians out there. By the way, this is really, really interesting. Cyclicals versus defensives. This shows the S&P 500 return around 7 major geopolitical risk events indexed to the start of the event. And you can see where we are right here. At negative 5% is exactly where we would expect to be. You bottom for another week, and then it just starts to rip higher. So I think this is what the next few months, couple of months is going to look like here. I just don't know which day we're going to bottom. I guess that's up to your tweeter in chief or truther in chief to make that decision. All right, moving next. Bullish oil bets rise to the highest since 2020. So that's all you need to know. You want to be a seller when everyone's crowded into one side of the trade. Earnings calls citing AI, 10-year high. Narrative fatigue. Look at this. Pure play oil ETFs, retail net purchases. You can't make this stuff up. I mean, I can tell you exactly what's going to happen in the next few months. So expect oil stocks to take a hit in the next couple of months. Our national oil, well, Varco, which we're going to talk about today, that's been moving up, and our Comstock that's been moving up, I would expect them to take a breather in the next few months. So just wait a few weeks before you buy any of that stuff, because I think everyone crowding into that trade is going to be disappointed in coming weeks with some tweet. High yield bond, debt to enterprise value. Here you can see the oversold that we were talking about from Bespoke. It's just extremes. We look for these type of things. Corporate debt as a percentage of GDP is still healthy. The overall theme, though, is active equity funds ownership of energy is still low versus history. So any weakness after the resolution announcement should be bought, and that would be an opportunity to reload. Despite the rally in the equal-weighted S&P 500 year-to-date, the average stock's forward PE versus cap-weighted remains less than 1 standard deviation below the historical average. So the 493 is still very, very cheap. You haven't seen it in 25 years relative to the cap-weighted. Here's another geopolitical overlay showing we're kind of right in the sweet spot of inflection. Magnificent 7 all down year to date. That wasn't hard to predict. Equity markets. Fund manager survey, most overweight commodities since April 2022. We were hammering energy the back half of last year every week in the podcast. And that's been the big trade of this year. I think now it's going to take a breather. So now that everyone's excited, but I think the long-term trend is correct. I think it will be a multi-year play along with emerging markets and et cetera. By the way, speaking of emerging markets, just want to run through these slides as a reminder for those of you who don't remember them. US versus international. Right now, no one wants to buy international. That's probably going to be the case for the next couple of months. But if you look over the next few years, you want more and more international exposure, and we'll continue to look for it outside of Alibaba. We have companies that have the majority of their revenues internationally and will benefit from that, but we want to get more actual exposure because this is the long-term cycle since 1974. The blue is when US outperforms, the red is when international outperforms, the blue is when US outperforms, and it's like a 10-year period each time. US has just finished it. Last year was the first year international, so this turned red. This is a shorter-term chart. And that tends to last for many, many years. So this year, international should outperform US. No one's positioned for that. You'll see how that plays out, just like no one was positioned for it last year. And you can see it here in the great rotations, Nifty 50, internet bubble. This one has been the most pronounced. You're going to see the weighting of the Magnificent 7 work its way down over the next few years. US outperformed international for 15 plus years, by far the longest stretch on record and nearly double the historical average cycle of 8 years dating back to 1975. 2025 marked the turning point with the US versus international price relative peaking at a 75-year high of 3.5 standard deviations above trend and rolling over since. Those loyal listeners of Hedge Fund Tips with Tom Hayes were prepared for that. International markets bottomed at just 33% of global market cap in December 2024, less than half of the 67% peak seen in 1994, and have since moved to 38%. So you can see it here moving up. Emerging markets are breaking out to new all-time highs after nearly 2 decades of sideways chop, with these inflection points often marking the start of powerful multi-year trends. So any weakness in commodities, in emerging markets, in small caps, in value are to be bought and to be held for the next 3 to 5 years. Forward PE ratios, you can still see the divergence. Despite international valuations starting to come off the mat from recent lows, they continue to trade at a significant discount to the US, with MSCI World ex-US at 14.8 times forward earnings, a 30% discount, and emerging markets even cheaper at 12.6 times, a 40% discount compared to the US at 21.1 times. Emerging markets are heading for their strongest earnings cycle since the mid-2000s, a period that kicked off a decade-long stretch of outperformance. Emerging markets forecast EPS growth of 32% in 2026 and 11% in 2027 is more than double the S&P's projected 15.3% in 2026, with earnings revisions accelerating to multi-year highs. And finally, international equities benefit from a weaker dollar, averaging 18.4% in down dollar years compared to just 5.6% when the dollar rises, at only 10% off its recent peak. That's the US dollar, and the average dollar bear market seeing a 35% drawdown. History suggests more to come, with every weaker dollar cycle coinciding with long stretches of international outperformance. You can see this dollar chart. It doesn't stop. It tends to be a longer multi-year thing, and the fundamentals support it. Cash levels shot up this week in the fund manager survey report. Sentiment dropped. Sharp drop in global growth expectations, so pessimism picking up. Asset managers net positioning, again, the lowest since COVID. That was a time to be a buyer, not a seller. Financials positioning completely washed out. %50 of stocks in the Russell 3000 are now down at least 20% from their 52-week highs in a correction that started months ago. So that this analyst, Josh Schaefer, is pointing out that a lot of downside has already been priced into individual stocks. We agree. Betty flags asymmetrically favorable equity upside conditions for the first time since November of 20. That's Barclays Equities Tactical Strategies. You can see it hasn't got this extreme since the last pullback. Home buyers, home building, slow. It needs rates. It'll get them. It's just going to take till May, another 2 months. Boy, we got a lot of stuff. Put call ratio, again at an extreme. When you get put call ratios this aggressively high, those people don't get paid. And that's either because the market grinds sideways or it rips higher, but it never rips lower to pay these people out, very rarely. They're the bag holders. People who buy insurance after the house is burning are the bag holders. S&P 500, when the put call is above 1.1, which we saw, on average, 1 week later, the S&P is up 4%. 1 month later, the S&P is up 6.8%. 2 months later, the S&P is up 10%. That's what we call a rip your face off rally. And it looks like we could be very, very close. So lot of great data this week. And here's the master himself, Warren Buffett. The stock market is a device for transferring money from the impatient to the patient. This is kind of the theme of what we do here at Hedge Fund Tips with Tom Hayes and Great Hill Capital. And his second quote is, a market downturn doesn't bother us. It's an opportunity to increase our ownership of great companies with great management at good prices. All right, so we'll get through some of these headlines here. We're going to blow through because we spent a lot of time just kind of giving you guys a lay of the land of how we're thinking about things so you can be zoomed out and not make the wrong emotional decisions when you should be making the right opportunistic decisions, which is to be a selective buyer. Not that you're calling the perfect bottom, but when you're taking a long-term view and you can buy these businesses that have been around for decades at really great discounted prices because someone's got a margin call because they own too much software and too much Mag 7. You say, amen, hallelujah, like Buffett says, when it's raining gold, you pull out the bucket, not the thimble, okay? And that's the name of the game. So Alibaba revenue. So here's the headline. I told you what actually happened. Now they're going to tell you all the things that went wrong. So Alibaba revenue misses estimates in December quarter as net income dropped 66%. They told you that was going to happen with the investment, et cetera. The name of the game, and by the way, just so you know, they came out and said they are targeting $100 billion a year in cloud and AI revenue within 5 years. It's like a whole new company you're getting for free. Alibaba hikes AI prices as much as 34% to meet demand surge. That's called a high quality business when you have pricing power. So we use the opportunity today to take advantage. Morgan Stanley says this China name is a global AI winner. They're referring to Baba. We talked about the deck. Alibaba AI business is a free call option, says First Eagle Fund. They're solid managers. They've been around forever. Why is this not letting me in? China AI giants offer better value than the US peers, top fund says. We couldn't agree more. They're a little late, but now's as good a time as any. China starts the year with fastest increase in spending since 2022. So that will be reflected in the first quarter earnings for China, which is the toll taker to the Chinese middle class spending. Trump expects Xi summit in 5 or 6 weeks as war rages. That'll help Boeing. That'll help Alibaba. New CEO Josh D'Amaro wants Disney's flywheel to spin faster. Amen. Hallelujah. What's this one? Seems to have logged me out of everything. All right. Disney Hoppers holds on to the top spot at the box office ahead of the Oscars. So you get that business for free. Vans Warped Tour wants to rock Canada, Mexico, and the U.S. this summer. Thousands of people, brand building. Bracken Darrell brought that back in a major way and is starting to get super duper traction. Baxter announces new CFO. Big warehouses are back in demand. When we were talking about that in 2024 with GXO, everyone looked at us like we had three heads. Now it's playing out. Opinion follows trend, and soon this will be much, much higher. QXO drives into a tech overhaul. That is what Brad Jacobs is doing with the building supply roll-up, which we own, and he will make his owners a ton of money, as he always does over the next few years. Builders blueprint to tackle the U.S. housing prices. Trump orders agencies to cut red tape on home building and mortgages. Federal Reserve to loosen capital requirements for big U.S. banks. This was a big part. Key. This is what you see in expansions: is credit expansion and reduction in regulations to drive growth, and then a crisis 5 or 7 years later. So game on, ladies and gentlemen. They're just starting the music. They just put the needle on the record. Get up and start to dance. Natural gas boom will spur a shortage of U.S. fracking gear, Shale Boss says. We like equipment services, and we particularly like National Oil Well Farco. Economists don't see a recession. Economists don't see a recession unless oil hits $138 and stays there for 3 weeks. Low probability. Not impossible. U.S. exploring, this is not without risk. When I talk about conviction in a view, I don't have a crystal ball, but I have history and I have probabilities and I have math, and that's what it is. Great investing is not about avoiding risk. It's about managing risk. And I know that even if there's short mark-to-market pain, the underlying businesses that I own in a concentrated ownership positions, when I look out 6, 12, 18, 24, they're better businesses and I got them at a great price. So the short-term mark-to-market, I don't even think about, as long as the underlying fundamentals are continuing to do what they've done for 10 years, 20 years, 30 years, in some cases 100 years. And I got to buy it at a huge discount because people got taken out of their stock and their ownership positions by short-term headlines and noise. And that's the opportunity over and over. U.S. exploring tying naval escorts in Strait of Hormuz to government insurance. Vessels seeking protection may be required to take out cover from the program run by Development Finance Corporation. So that was posted 13 hours ago. They're going to get these ships through. And when they do, if you're shorter in cash, you're going to regret it. Stock market euphoria fades as investors turn bearish. That's what we like to see. Big tech stocks have a free cash flow problem. We've talked about that for months. They're now at CapEx as a percentage of operating cash flow is 92. They're headed to negative free cash flow. That's why they're down. And that's why this counter trend bounce that's coming should be sold into the fall. And when they all start cutting back on CapEx and everyone says the AI trade is over, that's when we will start buying them. It'll be probably similar to fall of 2022 when we were buying Amazon and Google at 50% off. SEC prepares proposal to eliminate quarterly reporting requirement. We're okay with that. Pipeline and profit, stock market, and sentiment results. So this week we covered Comstock and National Oil Well Farco. But first, we're going to talk about a summary on the Bank of America Global Fund Manager Survey, which was 210 institutional managers with $589 billion of AUM. The key points were this. Number one, after 8 straight months below 4%, fund managers' average cash levels jumped from 3.4 to 4.3% in March, the biggest single month increase since COVID. And as we've said, this event, just like April, started with a tweet and will end with a tweet, with any positive news over the next few weeks catching positioning way off sides and driving the next leg higher. 2, Fund manager sentiment based on cash levels, equity allocations, and global growth expectations dropped sharply from 8.2 last month to 5.6 in March. While this marks a new 6-month low after a period of a frothy bull sentiment, it remains well above the Liberation Day low of 1.8 and nowhere near the washed out levels seen at prior cycle troughs. Sentiment has clearly come off the boil, but is far from true capitulation. 3. Fund managers are now the most overweight emerging market equity since February 2021 at a net 53% overweight, up from 49% last month. This rotation still in the very early innings as the longest streak of U.S. outperformance on record at 15 years is finally unwinding, with a weakening dollar serving as an added tailwind. 4. Fund managers now the most underweight consumer discretionary stock since December 2022, with net 27% underweight. If there's one thing we know, as long as unemployment stands at 4.4% and Americans have jobs, betting against the consumer rarely pays off. And 5, unsurprisingly, the March survey saw a big jump in global inflation and rate expectations, with a net 45% of managers expecting higher global CPI over the next 12 months versus 9% in February, while only net 17% still expect lower short-term rates versus 46% in February, the lowest reading since February 2023. National Oil Well Varco update. Heading into 2026, we made the case for skating to where the puck was going, not where it had already been. With that meant looking past the crowded trades that had already worked and beneath the surface of the market where the real money was still waiting to be made. Energy was one of those sectors. After delivering less than half the market's return in 2025, sentiment toward the sector had collapsed back to left for dead extremes not seen since the pandemic, when oil briefly went negative, and before that in the early 2000s. Our constructive view didn't come from genius or any magical ability to predict the future. It came down to a handful of indicators giving the green light for a catch-up move that looked long overdue. Fund manager exposure to the sector had fallen to record underweight levels, nearly 2 standard deviations below historical averages. The sector's weight in the index had dropped to just 2.8%, near-term records. Oil S&P 500 ratio sat at historical troughs, while short interest climbed to multi-year highs. When the rubber band gets stretched that far, extreme reversion to the mean becomes inevitable. We laid out the full thesis in detail in the article linked below. Fast forward to today, and the thesis has played out nicely. Energy is now the top performing sector year to date, up more than 30%, while the S&P has declined. It's more than that now, almost 5%. Conflict in Iran has only extended an already market-leading run, with the Johnny-come-lately crowd suddenly piling into the sector they wanted nothing to do with just months ago. Now that everyone has found religion in energy, history tells us it's the likely time for the sector to take a breather and shake out the weak hands. While the knee-jerk reaction to the conflict has rewarded large energy producers on the back of a 50% swing in oil prices, we think the more durable beneficiaries, once the dust settles, will be found further down the supply chain in the oilfield services and equipment providers. These are the companies supplying the pipes, drilling systems, tubing, and drill bits needed to bring damaged gas fields and energy infrastructure across the Middle East back online. Once the rebuilding begins, demand for this equipment is about as close to guaranteed as it gets and offers far more insulation from short-term oil price volatility than owning producers directly. All of which brings us to one of our favorite pick and shovel plays, ways to play the energy sector. National Oil Well Varco, a leading provider of oil field equipment and drilling systems. For newer readers, here's a quick overview of National Oil Well Varco and the key drivers to our thesis. So you can go through this and see what our original thoughts were and how that's played out. By the way, while you're at hedgefundtips.com, click on terms. The other thing we didn't do is acknowledge all the people that sent in pictures for their merch. We're very grateful to do this. And, some of you can't afford to become clients. Most of you who've listened to the podcast and can afford to become clients have. But all we ask is just share it with one person that you think could benefit from this information. And a lot of you have done that by wearing the merch, the Hedge Fund Tips hat, the mug, the t-shirt, the hoodie, which is my favorite, all fantastic. And we got a bunch of new pictures in. So we've gotten probably 20x the amount of orders that we have the pictures, but we got a few new pictures. Here's Guglielmo Promoli in his awesome hoodie. So congratulations on that. And you can go through all the pictures and do what you can to get your picture up there and meet some of the community of the hedge fund tips and sharing this. The longer you share this, the more I'm going to do it for non-clients, free of charge. And I really enjoy it every week. So keep sharing. As we keep growing, we'll continue to produce for you and give you these benefits. So while we can't predict the next move in oil prices or the next headline out of the Middle East, what we do know is that once the situation diffuses, NOV will be busier than a one-armed paper hanger keeping up with equipment orders. Couple that with the estimated $100 billion plus required to rebuild Venezuela aged and neglected oil infrastructure. And there are plenty of reasons to be constructive on an equipment provider like National Oil Well Varco right now. In fact, in just the past few weeks, NOV has already received new orders out of Venezuela with a value exceeding everything the company generated from the country over the past several years combined. A lot of unexpected tailwinds are working in NOV's favor, something the company hasn't been able to say for a long time. Management spent the recent downturn doing unglamorous work of exiting underperforming markets, right-sizing the company, and taking over $100 million of costs out of the business. All that having left National Oil Well Varco well positioned to ride out an extended upcycle driven by the return of offshore and international exploration, with Venezuela and the Middle East rebuild sitting as free options on top of the core thesis. In the meantime, management continues rewarding shareholders by returning over 50% of free cash flow in the form of buybacks and dividends, all backed by a fortress balance sheet with $1.55 billion in cashola. While the stock has certainly been an early winner from our original cost basis, we believe we're in the early innings of a much bigger story. Until then, we're happy to collect the dividend and sit on our hands while the thesis plays out. So we have highlighted all the key things from the press release, from the earnings call transcript, from the company deck, and also outlined the 10 key points of the most recent quarter's earnings. And we're super excited about that, including the repurchases, including the dividends, including the overall thesis. So check that out at hedgefundtips.com. While you're there, click on terms. This is all opinion, not advice. Our second update was from Comstock Resources, which we also put the original thesis and the key drivers behind our original entry, which was between $8 and $9. And we think this is going a lot higher, and we love having a partner with Jerry Jones controlling 71% of Comstock Resources. He invested $1.1 billion of his own money, and he believes that this asset is worth well more than his interest in the Dallas Cowboys, and we couldn't agree more. Lowest cost producer, great location, incredible execution. So you can go through these top 10 points from the most recent earnings report, and you can understand why we're in the position and why we're very positive about the position moving forward. That's all at hedgefundtips.com. But we've got a lot of Ask Me Anything questions to get to, and want to just point out one thing on market sentiment here. You can see the fear and greed all the way down to extreme fear. These are levels from which you often get big bounces. National Association of Active Investment Managers, lowest exposure since the tariff lows last April. So again, better time to be a buyer than to be a seller. Congratulations to all the new clients that came in intra-quarter with larger sized accounts, and to those existing clients who upsized their contributions to their accounts. We have reopened to, we're reopening to smaller accounts, $1 million plus, again, starting April 1st. Those interested in going live on April 1st can begin onboarding the application ahead of time, and many of you already have done that. By the way, there are a lot of you who have emailed us and not received a response yet. Our apologies. We will get back to you over the coming days and make sure everyone gets onboarded in time. If you don't receive a call by Sunday, then just re-enter it. We'll make sure you are top priority, and very grateful for that. So you can just go at hedgefundtips.com, click on money management, or just go to greathillcapital.com and enter your information there. Not a solicitation. Again, all of this is opinion, not advice. Moving on to earnings. Earnings top 30 weights of the energy sector. Estimates were revised up 2.6% in the last 60 days for this year, down 1.2% for next year. Defense sector, top 30 weights, earnings revisions, last 60 days, revised down by 58 basis points in the last 60 days for this year, revised up 23 basis points for next year. Economic data this week, what did we see? The PPI came in hotter than expected. That tends to be a noisy number, but it is what it is. So the market didn't like that. Housing, obviously, building permits were actually up a little bit. Okay, so that's good to see. That came in today. Initial jobless claims were lower than expected. That's positive. I mean, it's amazing how these things are just holding on. New home sales were obviously weak. I mean, you started a war. That kind of makes sense. But the pent-up demand is there. So that's what we go. Estimates, earnings estimates. I referred to this with Stuart this morning. For this quarter are 11.6%, for the year 15.3%. You can see how estimates have just shot up in recent weeks. It's not to say if we don't resolve this, but just look. It just keeps going up and up. While everyone's pessimistic, these estimates keep going up and up. They could come down pretty quickly if this war stays prolonged. But again, I wouldn't bet on it. It's a few ships through, and from a stock market event, it's over. Even if the bombing goes on for years, we saw a similar situation. Look, I'm just talking about the stock market here. I'm not talking about the moral implications, and the humanitarian implications are devastating, but we saw the same thing in Ukraine. So that's that. All right, let's get on to our Ask Me Anything questions from our incredible audience. Super excited to do this. And the first question comes from Michael Costa. Campbell Soup down massively, hasn't found its bottom. I think you're going to be okay with that. You just have to take a 3 to 5 year view. All right, let's take a quick look at it. All right, all the staples are getting hammered because if oil stays elevated, it impacts input costs, it impacts food, it impacts everything. And the narrative is that they won't have any further pricing power, so it will erode their margins further. These are the typical narratives that you get in the hole. They brought the share count down meaningfully over the last 15 years. It's trading at a 9 times free cash flow, 9 times earnings. Free cash flow has been steady. This is kind of a steady Eddie, buying the stock. Revenues have been growing. I think you're okay with this one. Like, I actually like this one. I don't think it's like, I like it like put it in the portfolio for clients, but to own this long-term, collect the dividend, have them increase my ownership. They'll figure out the brands, and their brands, by the way, aren't that bad. Campbell's, they have, they have, 13-year-olds aren't on GLP-1s. They've got these Pepperidge Farms, okay? Usually 40-year-olds aren't eating goldfish, but, they have the chicken noodle soup. Anytime you get sick, you're buying their soup. They've got, what do they have here? Pretty sure they have Pepperidge Farms. By product lines. Pace, Prego, V8. So they've got a good, I think you're generally okay. What's it going to take to turn around? You got to listen to the calls and listen to their story, but I think your margin of safety is pretty good if you take a long-term view. I just don't think I'm going to need a triple over a few years, so I'm not interested. Tim D, how do you manage drawdowns? You use the opportunity, you continue to do the work. And, the other thing you have to keep in mind is like, there's a reason you have, we run concentrated portfolios, 8 to 12 stocks, but there's a reason you have 8 to 12 stocks, because there's always something that you can't know, or something that can happen that you have no control over. Otherwise, we would just have 100% of the portfolio in our highest conviction position. Every position we put on, we say, what if there's something that I don't know that I don't know? Now, these things have been around for 30 years, 50 years, 100 years, like, going to be very hard to surprise you like that. But let's just assume it goes to zero. Are the remainder positions in the portfolio have a high enough IRR that if one went to zero, that we could still dramatically outperform with the remaining 7 to 11? And the answer is always yes. So if you ask me about one company that's taking longer than expected, it's like, I expect that. That's priced into portfolio composition. Now, if you listen to a podcast and you pick one stock and you put all of your portfolio in one idea, well, you're just reckless. I mean, who would ever do that? You know, it's not a business that you run. You're an owner, but you don't run it. You don't have full control. So that's why you have to have some diversification. But if diversification gets over 15, mathematically, if you look at all the academic studies over the last 40 years, it's not impossible to outperform, but the odds are dramatically against you. So it's the perfect balance of, you can miss on one or two, and because the expected value on the remaining 8 to 10 is so high, that even if one or two fail, the other's outperformance will more than put you where you need to be net of fees over and above the index to make clients super duper happy, to compound their money and double over time. If you compound money at just 15% every 4.8 years, your money doubles. So if you start with, most people can't relate. Okay, let's just say you start with 2.5 million. Okay, not 25 million, but 2.5 million in 28 years. That's 128 million. Okay, or it's like 120 something million. Okay, 128. Yeah. If you start with 25 million in 28 years, that's 1.2 billion. Now, most people that have 2.5 million or 25 million today are not going to wind up with 1.2 something billion or 120 million 28 years from now. Why? Because they're going to get seduced by the headlines, and they're going to get tempted by dabbling. They think they need to be involved in everything because it's a headline, or they're going to chase the shiny objects and lose half their money in the next tech wreck, or whatever happens to be the shiny object of the day. Or they're going to go all in at gold at 5,000 and then wake up at 2,500 and say, what happened? What happened is what happens every cycle. Wake up, look, zoom out, okay, and just look at the long-term view, and these things rinse and repeat over and over again. So they'll do two things. Number one is they'll not follow Warren Buffett's core principle, which is to pretend that at the beginning of your investing life, you get a punch card with 20 holes, okay, which means you can only make 20 investments in your entire life. If you went after every investment with that framework, you would say, is this good enough for it to take up one of my 20 opportunities in my whole life? And Buffett said, if you go about it in that business-like way, by the time you're at 6 or 7, you're not going to need the other 13, because you're going to have made so much more money by thinking about it in a business-like way, like you would if you were running your business through acquisition, how you would buy a competitor's company and how you would value that. You apply that same principle to public markets investing, rather than just looking at a thing on the screen, and because your idiot neighbor made 5x on a shiny object, you chase up to them, like we've covered about Sir Isaac Newton in the South Sea bubble, and you wind up getting monkey hammered. Okay, good businesses at great prices, durable cash flows, buy them when they're out of favor, rinse and repeat over and over again. So that's that. Next, okay, Patty's just saying he went to his dentist and he saw Dentsply Sirona everywhere. Of course you did, because they own the market, and we're getting to buy a great business at a good price, or great business at a great price in this case. And maybe I'd say good business, because the new CEO is just getting started. Good business at a great price. Max M, Bausch Health, we've covered that before, not interested. Joel Karen, that's a question for Jeff, we'll handle that. Alejandro Campbell's, same story. We just covered it. It's fine. Will Bonner. Wow, everyone's asking about Campbell's. Is this the next meme stock? I mean, are they pushing this thing on social or what? Or you guys are just learning how to think properly about investing? And I kind of agree with you there. I wouldn't mind owning this one. I mean, would I put this in the... Oh, here we go. the Goldfish, the Cape Cod chips. What's not to love? Campbell's Chunky Soup. Rayo's is the growth engine, by the way. For those of you who've been to New York, if you can get into Rayo's, it's just an awesome experience. Thanks to my buddy Rick, wink, wink, who got me in a year and a half ago. That was just super incredible. Lance's, Snyder's, Pepperidge Farm, Kettle brand snacks. They got all the great stuff. The best salsa, pace. You can say, people are on GLP-1s. It's not going to work, blah, blah, blah. Look, kids don't take GLP-1s, and a lot of these people on GLP-1s get off of it because they want to go back to eating or they can't afford it or whatever, and they'll be back, okay? Same thing with the Diageo. All right, SPCB. Let's take a look. This is from Almas. SPCB. But yeah, all four of you with your Campbell's, it's absolutely fine. This looks like a Supercom Limited PCB. I guarantee you that they're just diluting the hell out of you because that's what they've done, and we don't. Yeah, so they've taken the share count from 99,000 to 4 million in the last 3 years. These are what we call in New Jersey parlance scumbags, okay? I would never do management business with any manager that does this to their owners. So I don't care what they're doing. They think they're curing cancer, whatever they're doing. What they're doing is screwing their owners and partners, and we're not interested in people like that. Next, Matthew Wortley, Dutch Bros. Huh. Yeah, this is pretty popular out here. I have looked at this. So it was a 4-bagger. It's now corrected almost 50%. I still think it's overvalued, though. Let's take a look. I mean, it's kind of a growth story. They're going to keep expanding. Let's take a look. So they're free cash flow positive. The revenues are growing. The share count, though, I don't love how this is going up because they've doubled the share count in the last 2 years. So you're not getting the full benefits of the improvement in the business. And it's like, why do they have to keep doing it? They're raising capital for expansion. Fine. I mean, let's just see here. So description overview. All right, so 55 times earnings, 3 times sales, 20 times EBITDA. And what's the growth rate? 20% top line, 30% bottom line. So it's kind of 2-peg. What's the balance sheet look like? This type of stock's a lot more speculative than I'm kind of interested in, but at a price, I'd be more and more interested in this one. It's just not this price. So balance sheet's kind of healthy. I think this starts to get interesting. I mean, at $30, I'd probably be backing up the truck. At $50, $45, maybe you're right over the next 5 years. It's just, there's no urgency for me to get involved in this at this levels. So next, Rahul, Muller Industries, MLI. So this is up 15x in the last 6 years, and now that it's pulled back 20%, you're getting interested. I'm going to say hard hell no, and welcome to the podcast. I think it's evident that you're new, and we welcome you, and you're going to learn a little bit different framework as you are with us. So you can see here that obviously free cash flow is strong. It's back to levels that you saw in 2023. before it started this kind of parabolic move, and now it's up 3x that. So you're paying 3 times for the same amount of cash flow. Revenues are effectively flat over that period. Balance sheet's good. They've taken the share count down a little bit, but you missed this one. So right company, wrong price. Price is what you pay, value is what you get. Chris Booker, Copart. Yes, I like it. You can buy it. Roman, Hits, EPAM, software company. These are all going to bounce. I don't want to own them. It's definitely going to bounce. I'm sure the financials look great, but I have no edge on their moat and whether it can be disintermediated. So therefore I don't play. Similar to what Buffett did, and he did just fine over the years. So free cash flow is good. Revenue starting to recover. Share count modestly down. Margins down materially. It's a strong candidate for a bounce, that's for sure. I mean, this whole group is going to bounce when the market headline comes out. They're going to be the first ones, first in, first out. 10 times earnings, growing 10% a year. So it's a one peg for a software company. You tell me whether they have a moat. So that can't be disintermediated. Platform engineering, software development services, implementation, cloud services, blah, blah, blah. Word salad. I think it works for a trade. I wouldn't want to own it. Addis, Klempic. Appreciate all the knowledge. Can you give me your thoughts on Nike? Yes, it's a buy here. Close your eyes and wait 3 to 5 years. It'll go against you before it goes for you, but this is all in the consumer discretionary bucket, which is overdue for an aggressive bounce. And then a long-term play. Coupang, this is Korea got monkey hammered in the last few weeks. It's expensive, but I kind of like it here. It's the Amazon of Korea. Watching your podcast. That's a spam. Thank you very much. Meditech, AFX. Looks like price has followed free cash flow pretty accurately. Free cash flow is picking up. Revenue's been flat the last few years. Share count's down. Price is down to $23 from 189. Let's take a look at I think this is just a balance sheet question. As long as their product moat is not permanently breached. Ophthalmology, microsurgery, eye diseases, glaucoma. So this is eye stuff and laser surgery. Yeah. Okay, let's see. Oh, this is a tiny company. So you got $500 million of debt, and you got 32 million of cash with 800 million of receivables. Sales have been kind of flattish the last few years. Share count steady. No material stock-based comp. Free cash flow, 200 million on $500 million of debt. I'm kind of okay with that. Yeah, you're probably okay with this one, Vicky. Good work. Brendan G, thoughts on NX? I don't think you're going to get a double in a few years. I can tell you that out of the gate. But let me just see what it is. NX. Free cash flow starting to recover. Revenues at all-time high. Margins okay. Return on capital got impaired. Balance sheet. $62 million, 189. How much debt? 623. They've got $100 million of free cash flow. Yeah, I mean, I just think there are higher and better uses. I think this is okay. You could probably get. It just seems like a very slow growing business. You've had a big bounce off the bottom, a double off the bottom. So now you're pulling at $15. I might buy it for the long term, but I think there are higher and better uses. It's not bad. Bob G, Step. STP, Stepstone Group. So it was like 4-bagger. Now it's down 50%. Is this a software company? No, shares going up, cash flow deteriorating, no signs of recovery. I think this is going to work back down. What do they do? Private equity venture capital firm, fund to funds. No, this is a no. At hard no. Alex Saunders. Asking about X-ray. You always get these questions when the prices are down. Yeah, look, you have risk with $2.5 billion of debt. There's no question, but they'll be at a normalized $400 million of free cash flow, and you've got you got the new CEO from Globus who's done this before, done the integration, buying in shares. They're going to be back buying in stock within the next 4 quarters. We covered that in the article 2 weeks ago. So just go through all that. We actually addressed all of that. And there's a reason the stock is down, why we're buying it. Number one is all of this is known. I love when people come to me with like bad news after the stock's already down 80%. It's like, that's why we're buying it down 80%. All this bad news is known. First, we do solvency risk. We feel pretty darn good about it with cash flow getting back to normalized levels of $400 million. They'll pay down debt. They have optionality. They could sell off the bladder business if they had to pay down business. And that's what we look for in turnarounds like we had with VF Corp. What can they sell if they have to? Usually they don't have to. We did the same thing with Cooper Standard. Their property, plant, and equipment was $700 million. We knew they could get it refinanced. They did. And so on, rinse and repeat. Alan Dapp. NOMD, Nomad Foods. I get this one a lot, and I usually just say no. I don't think the brands are strong enough, but at this point, you probably get a bounce. All right, let's see. Price has been declining with cash flow. Revenues have been flat. Share count's coming down a little bit. What brands do they have? Frozen food products in the UK. Yeah, Bird's Eye Peas and all this stuff. Yeah, I never loved the brands, so for that reason, I understand the financials are okay. And let me just take a quick look at the balance sheet. There you go. $2.5 billion of debt. Doesn't have a moat like X-Ray has. I mean, I think you're okay with this one. Rates, the thing about the dividend pairs, what's the dividend on this? is they bounce when rates go down. So all these staples will get bid again. Right now they're getting hit because what's the dividend yield? Is that here? 7% dividend yield. I think you're generally okay on this one from these levels. Yeah, I wouldn't be racing out to buy it, but I think it's going to work for you. Alex A. He's asking about, yeah, Zoom. That's Zoom's no for me. I understand the story there. I think it's going to be a value trap. I don't see any real catalyst to turn around, but certainly it's going to have a place in the world like Peloton. CTSH hasn't fallen enough for us to get interested. So with that said, I want to thank everyone for tuning in. We will be back. Let me just see. Oh, here's another one. SCHO. It's a Danish industrial company around since 1878. And this is from Anton Ellerman. Yeah, I mean, the price, though, has already reflecting the recovery in performance. This was the time to buy it. You see right here? Free cash flow had turned positive and the price was still going down. So at 406 was the time to get interested, and then it shot up to 672. So again, you would have only made a 50% return in 2 years, which is okay. They're taking the share count down. They're doing a lot of right things. Problem is it's already up a lot, and it's reflective of what's already happened. And this seems to be a pretty cyclical business. Every few years goes negative free cash flow positive, negative free cash flow positive, negative free cash flow positive. So you're kind of here toward the top of the cycle. I don't think you're going to get enough juice out of that. So for that reason, I'm out. We'll be back next week, same time, same place. I got a few days in New York, and so we'll have a lot of media next week, a lot of good stuff, and we'll take it from there. So in the meantime, make it a great one. Bye for now. Pause your video player to review our terms and disclaimer. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Great Hill Capital LLC or PPI is not under any obligation to update or keep current the information contained herein. Great Hill Capital LLC or PPI and its respective officers and associates or clients may have an interest in the securities, derivatives, or entities referred to in this material. Great Hill Capital LLC or PPI accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.